All right, good morning, everyone. I'm going to go ahead and get started. My name is Todd Bartman. I am the CPA here at Capital City, and I've met some of you, but not all of you. And so I'd like to take a minute to introduce myself, but I'm here to do forward-looking tax planning as it relates to your investments and your overall income tax exposure. And so today I'm going to talk a little bit about the tax environment that we're in and what may be coming or maybe not. And so we'll go through that. At the end, we'll answer questions. So if you have a question along the way, you can just go ahead and type it up in the Q&A, and Audrey will compile it throughout the presentation, and we'll answer the questions then, so we can combine them into questions that are all the same. So I'm going to go ahead and get started, and I hope you all have a good time. All right, so what we're going to talk about today, first, where we are now, where we could go from here, and then what we can do about it. Because, you know, tax is tax, and there are some things we can do to plan for it, and sometimes we just can't do much. And so we need to look at it. We're going to look at it in terms of what current law is, what proposed changes to the law are, and at the end of the day, our planning has to relate to current law. So most of you are retired or near to retirement. And so, the big question is, what are taxes going to look like in retirement? Will they be lower? And so for most people, taxes will not be lower in retirement. And that's because everybody has a silent partner. And the silent partner is the Internal Revenue Service. We spend our entire lives saving. We put money into what is a qualified account, which is a tax deferred account. And the promise is that we're able to allow our money to grow in there tax deferred, but when we take that money out, taxes due. And so most of us have savings that are, going to be taxable once we begin to spend that. And so when we get the statements that we see in the mail on our qualified accounts, not all of that money belongs to us. A significant portion of it will be paid in tax. So question one, where are we and how did we get here? The Tax Cuts and Jobs Act is set to expire at the end of 2025. And so what that means is we will go back to 2017 income tax rates. And this will happen without Congress doing anything. Congress does not have to pass a bill. This is current law. Unless a bill passes, we can plan on this happening. A bill would have to pass Congress for something different to happen. So, from a tax planning perspective, this is really where we want to do most of our planning, because it has a better chance of happening. But we also have a proposal, President Biden's proposal for changing tax law. And what does that look like, and how will that affect us? So we do want to take that into consideration. It is possible, but Congress has to get together and pass that for that to be tax law. And so, how likely is it of passing? There are a lot of people who do not want this tax bill. Congress is fairly divided. And so the big question is, will it pass? And the answer is really, it's anybody's guess. And it's not current tax law, but we will talk about it. We also have COVID right now. And so, this is a big part of how this will all play out, because spending has gone through the roof due to COVID. Right now, we've spent $3.6 trillion on COVID. We've got another $1 trillion budgeted for a total of $4.6 trillion just for COVID. And so, the country is spending a lot of money, and that has to be paid for in some form or fashion in the future. Right now, the U.S. national debt is close to $29 trillion right here. And so, it's through the roof. It's 125% of GDP. Back in 2000, it was only 56% of GDP. So our debt has really increased compared to our gross domestic product, which is basically what the country produces, or we could look at it as our income. And so this is our debt to income ratio, would be a number that a bank would look at, but this is for the country. And so last year in 2020, from the first quarter to the second quarter, our debt to income ratio increased significantly. That was just over one quarter, and that is entirely due to COVID spending. And so we can ask ourselves, which way are taxes going to go? The debt to income ratio, the higher it is, the harder it is to pay that back, because it takes more of our money to service debt. And so I think we can agree that taxes will be going up. And we know they're going to go up based on current law, which is the Tax Cut and Jobs Act expiration. But we also have the Biden proposal on the table. Both of those items will increase our taxes. All right, so what happens when the Tax Cuts and Jobs Act expires? Right now, for a married individual that's making somewhere between $81,000 and $172,000 in taxable income, they would be taxed at 22%. Under 2017 tax rates, they would either be taxed at 25% or 28%. And so, that's a tax increase, but it's not just the marginal rate. If you look, these brackets, each dollar that you earn in that bracket is taxed at that rate. And so you typically your effective tax rate is going to be lower than your marginal tax rate. But all of these brackets, shrink. So this is 19 down to 18, 81 to 75. And so more of your dollars are going to be taxed at a higher rate all the way through the brackets. And so that will create a tax increase, and it'll be more than just the marginal rate. And if you want to look at the marginal rate, some people think of it this way. It's not a good way to think of it. It's incorrect math, but 22 to 25%, that's only a 3% increase, or 22% to 28%, that's only a 6% increase, but that's not right. That's improper math. The actual math on it, 22 to 25% is a 13.6 increase, and 22 to 28% is a 27% increase. And so it is a significant increase in the marginal rate, just going back to the 2017 tax rates. But also, in addition to that, the standard deduction will be cut in half. And so that will, it'll be a further increase for some people. Now, one of the positive things is with the increase in the decrease in the standard deduction, many people will be able to itemize again. So it might not hurt quite as bad just in the standard deduction, but it is still going to be a factor for many people. But what about Biden? Okay, so his proposal. His proposal starts off, he wants to increase the top tax bracket to 39.6. This is the 2017 tax table, and you can see that it was 39.6. So that's not much of a change. But he wants to reduce the rates or reduce the bracket. So it would kick in at 452,000 instead of 470,000. So there'll be some other shifting of the brackets in there. So, if under Biden's bill, people might see an additional marginal tax increase as well from the 2017 brackets. So he wants to introduce a 39.6 top marginal rate. This is the big one. This is what is getting people kind of worried. He wants to tax long-term capital gains at ordinary rates, okay? But he wants to do this on incomes over $1 million, okay? So a lot of people are not gonna fall into this, but if you are gonna fall into this, if you have income over $1 million, you're going to see your rate on long-term capital gains go from 20% to 39.6%, which would be the top marginal rate. And then you're going to, on top of that, have an additional 3.8% net investment income tax. And so the long-term capital gains rates for people with incomes over $1 million will double. It is a significant change in tax law. And so it really has people up in arms or worried about that. This is another thing. So he wants to have capital gain recognized on gifts or estates. Okay, so if you have a capital gain on a gift or an estate over $1 million, it will trigger a recognition event. So the way it is now, if I have a capital gain on a gift, if somebody gives me a gift, then I get their basis in that. Hold on just one second.
What about single people?
Yeah, single people, I think on what? On the capital gains?
I think so.
Yeah, I think that it is $1 million capital gain for per individual, and I think that it is the tax brackets. I don't have them pulled up for single people, but Audrey, if you get the name, I will get the tax bracket put together for single people. All right, so if I get a gift, my basis in that gift would be the basis that the person paid for it. The basis transfers to me. All right, and so if I got a gift of a $2 million property and the basis was $1 million, there would be a capital gain. All right, now under old law, I would have $1 million in basis, but it was worth $2 million, and nothing would happen until I sold that. Under this proposed tax bill, the gift would actually cause a recognition event, and so the capital gain tax would become due at the time of the gift. And so there are some exclusions to that. If it's a closely held business, the capital gain isn't due as long as the business owners or the family is working in the business, or if it's an illiquid asset, tax can be spread over 15 years. So you don't necessarily have to sell the property to pay the tax for those type of gifts. Also, the same would be true for capital gain on an inheritance. So if I inherited something that had a capital gain, then there would be a recognition event at death, and so that capital gain would have to be recognized. The exclusions would apply. So transfers between spouses would be excluded. If my wife passes away and I inherit an asset from her, there's no issue. If I give a gift to charity, There's no recognition event, so those would still be protected donations. Heirs of small businesses and farms, as long as the family continues to work in those businesses, there would not be a recognition event in that case. The appreciated stock would also be an exception. A couple more things I want to go over that I don't have a slide for. Pass-through income. So people who have S corps or partnerships, if they have income over $400,000 coming through on the partnership or S corp, they would that income would be subject to self-employment tax. Now, on a partnership, typically it would be anyway, but on an S corp, that is not the case. So that is a significant change. That is a lot of reason why people actually make an S election, is to avoid that self-employment tax. If it was passive income, it wouldn't be subject to self-employment tax, but then it would be subject to the 3.8% net investment income tax. Also, like-kind exchanges for real estate would be limited to $1 million annually. So that is a new limitation that is proposed under this tax bill. All right, so what can we do about it? How do we protect ourselves from what is going to happen, either the expiration of the Tax Cuts and Jobs Act or the implementation of a new tax bill? And, a lot of this proposal from Biden is not going to affect a lot of people. The $1 million income is going to restrict that to only certain people, but it is still a significant tax increase. I'm sure a lot of you have heard that $1 million number and have said, okay, well, this is good because it's not going to affect me. And it is good that it won't, but it is still something we need to talk about and plan for, because there are people that it will affect. So a micro view of taxation, that's your individual return. And that's what we look at when we're doing tax planning as it applies to an individual. And that's, we look closely at the numbers and try to determine the best strategy for them. Kind of what I'm going to talk about here, because that is a more individualized subject, is a macro view, and how can we plan for just in general. All right, so we're going to take a macro view of taxation. That's a mile high view. And so we have three different kind of tax buckets. And so we have an income taxable bucket, a tax deferred bucket, and a tax-free bucket. So the income taxable, this is our normal income, our pension or wage income, stuff that comes from a pass-through, capital gains, both short and long-term, dividends, interest, distributions from mutual funds. And all of these, or most of these, with the exception of this one, would only be income taxable now if they were held outside of a qualified account or a Roth. So this is your regular joint account after tax money, or your pension or wage income on your tax return. Next, we have a tax deferred bucket. This would be your IRAs, your 401ks, 403bs, all that. And so this is money that the government said, okay, you can allow this to grow, but we are going to tax it eventually. And that's the tax deferred. Then we have the third bucket, income tax free. That includes our Roth IRAs, which we could have either been saving for throughout our lifetime or converted, municipal bonds, and life insurance. And life insurance is, passes tax-free if it's done correctly. And so it is a large planning tool under, these proposed changes and the expiration of the current tax law. So an income taxable, where we hold our assets matters, okay? And so we have these three different tax buckets. And if we're looking at our overall portfolio, our overall investments and how they all interrelate and work together based on our time horizon and our risk tolerance, we come up with an allocation of how many, what percentage of growth investments we should have, growth and income and, bonds or fixed income. And so we have a portfolio that we want to, objective that we want to hit. But where we hold those different assets matters, because in this income taxable bucket, our pension and wage income, our business pass-through income, our short-term gains, and our interest and some of the dividends are taxed at ordinary tax rates. Okay, so under the expiration of the Tax Cuts and Jobs Act, this money is going to have a little bit of a tax increase. Also under Biden's plan, this money is going to have a little bit of a tax increase, but all of these types of investments are taxed at ordinary rates. Also in this bucket, we have long-term gains, some dividends and distributions from mutual funds. These investments are taxed at more favorable capital gains rates. Now, under the Biden proposal, some of these investments for some taxpayers would be taxed at ordinary rates. But for most people or many people, there's still going to be a more favorable long-term capital gains rate in this bucket. However, in this bucket, this is the tax deferred bucket, everything is taxed at ordinary rates. It always has been. So if we have a high percentage of long-term capital gain in this bucket, we're paying too much in tax. We could pay a lower tax rate in this bucket if it were in this bucket, or if it were in this bucket, we would pay actually no tax. So the different buckets that hold our assets will impact the amount of tax that we're going to pay on the growth or income of those investments. Because, in this bucket, the Roth bucket, short-term, long-term, dividends, interest, it doesn't matter. There's no tax on the investments in there. So we have to not only allocate our investments based on our risk tolerance and time horizon, but we also have to consider allocating them into the different buckets based on the income tax results from those allocations. All right, so we can take advantage of lower, and you all know this, but we can take advantage of lower tax rates now. We have 5 years of lower tax rates, assuming that a tax bill doesn't pass. And I think a lot of people are assuming a tax bill won't pass. We can never be 100% sure, but I think that from right now anyway, from a planning perspective, it makes the most sense to count on a tax bill not passing and continue to take these strategies for Roth conversions and pay a lower rate now. And so, like I showed you before on the slide, these marginal tax rates will increase in 2026. If we have, not everybody has an opportunity because they might be in a real high tax bracket all the way until 2026. But some of us can take advantage of this, convert some money to a Roth asset. There's not a limitation on the amount you convert. It's only limited by how far up because when you convert, you pay tax now. So you're limited by how far up on the tax bracket you want to go. And so we have to make a decision on that. We like to look at this and keep it low. We don't want to pay too much an effective tax rate to convert dollars. So, that's a consideration. And basically we're moving the money out of the tax deferred bucket into the tax-free bucket where we can grow that money, have a longer time horizon. I know a lot of people are concerned, well, what if I pay the tax now, I convert these assets, and then, they say that a Roth account is no longer tax-free. I haven't heard anybody talking about that or seen anything on that. I imagine that existing Roth accounts would be grandfathered. But then again, we have to plan based on what we know to be true, not on our fears of what may be true. And so it makes sense for most people to look closely at this and see if it'll work for them. And so, that's the approach that we take at Capital City. We look at tax. Tax is an important part of your overall financial picture. For many people, it's their biggest bill in retirement. And so it's something that should be considered annually, and just make sure that everything is being done in the most tax efficient manner. And that means from an income perspective now, but also tax efficient treatment of what happens to your assets when they are inherited by your beneficiaries. So the estate portion of that is also an important part of the picture that needs to be looked at on a regular basis. Income planning is something that everybody needs to look at in retirement. We need to be able to fund your goals. Everybody's worked hard throughout their life. And so we need to look at what you need to have in income and how much you plan on spending and try to come up with something that's going to work not only to provide you with the lifestyle that you're used to, but also to make sure that your money lasts throughout retirement. And then investment risk and growth, that's your time horizon and risk, and that plays into all of the other items in healthcare, which is most likely going to be your second largest expense in retirement. It could be the first, and so we do that planning here as well, as many of you know. So that is my presentation, and I will go over some questions now and be right back with you. Just hold on 1 minute.
All right. How many of you are screen?
Yeah, I guess so. Is that the better thing to do? Okay. Okay, so the Roth versus the municipal bond. Municipal bonds are tax-free. Many of them are both federally and state tax exempt. They provide good income. They do have some risk. I mean, if interest rates go up, those bond values will go down, but they do provide tax-free income. Municipal bonds are included in the calculation for taxable Social Security. So, and also they are included in the calculation for Medicare. So, they're not completely tax-free, I would say. I mean, but the income is tax-free. They don't grow though. So they're going to produce income for you, which is great. It's going to be tax-free income. The Roth IRA, if you have some IRA assets that you can convert to a Roth IRA, can produce tax-free growth. And so that's a different part of your portfolio, but there's certainly a place for municipal bonds in a portfolio. Okay, so state tax, right now, itemized deductions cap taxes paid to, states at $10,000. That was a new thing. And so a lot of state tax is not deductible, okay, or up to $10,000. And a lot of people are then below the standard deduction, so they're not deducting it. A lot of people might choose to move to another state with a different state tax treatment as well, like Florida, Texas, something like that. But state tax, when the Trump tax cut expires, that limit under current law will expire, and so state tax will be deductible again. So it does impact your federal tax planning. But yeah, I mean, it's something to consider. It is added on for many of our clients. It's not a huge planning area. If you get into municipal bonds, you can find some that are both state and federally tax exempt. But typically the state tax doesn't, especially for retirees, doesn't do nearly as much damage as the federal income tax. So we concentrate our planning around the federal income tax. State tax piggybacks off of federal taxable income, so good planning in the federal area will also be good planning in the state tax area for the most part. We will have access. We've recorded the presentation, and so we will make it available after we do some editing, because we have a lot of dead space at the beginning of the presentation. So we'll edit that out first, and then we'll make the presentation available. And so, yeah, I see the single taxpayer question again. Yeah, I didn't put the single taxpayer brackets into the slides. So what I will do is I will get that, and I will address that. I don't have it in front of me easily, so I don't have the bracket, but I will address it for anyone who is single, and that applies to them, so that information is available. I'll put it in the slides, which I'll also make available and send out an email. So are there any more questions, Audrey?
I think it was just those. Well, maybe one more popped up. Did you get that one? Oh yeah, you did.
Yeah, that one I did.
Yeah, I believe that's it. No,
Okay. Okay, so the income annuities where the income has been turned on, can they be converted to a Roth? I don't know. I don't know the answer to that question. I would think it would depend specifically on that annuity contract, and whether the insurance company, how they account for the value that they turned on in terms of income. But I will get an answer to that question as well. And it may be annuity specific. So I will, get a general answer if it's annuity specific, and get that answer out to you as well. And if there are any other questions.
One more.
Okay.
Wait. No.
That was it. Okay. So that looks like all the questions. I appreciate everybody's time today. And we will get that additional information out. It was nice to meet with you. Sorry we couldn't have sizzling steaks sent around for this one, but maybe next time. Thank you very much, and you all have a good day.
Oh.